Good afternoon, everybody. First of all, I'd like to say that I wish I could be there in person, and I hope to be able to come to Korea soon. But today I will be focusing on updating you on our asset class preferences as we head into the second half of the year. So this slide gives an overview of the main factors that we are tracking in order to plot potential scenarios going forward. Naturally, the first half of the year has been unprecedented in terms of both the economic contraction experienced across the globe as country after country went into lockdown, as well as the policy response we have seen. The good news is we are already seeing the benefits of the record fiscal and monetary policy stimulus measures in both the economic data and also in the bottoming in corporate profit expectations. Governments and central banks have also signalled their willingness and ability to do more on the policy front if the situation warrants. Both the US and Europe are contemplating further fiscal stimulus as we speak. Of course, it's not all positive. COVID-19 infections have exceeded 13 million globally, with over 500,000 related deaths. Meanwhile, the recent experience has shown just how difficult it is to sustainably curtail infection rates. We've seen new record highs in large southern US states such as California, Florida and Texas. In the meantime, the pandemic continues to worsen in key emerging markets such as India, Brazil, South Africa and Indonesia. And finally, we've seen potential second wave coming through in Europe. So until a vaccine is found, which is probably unlikely until the end of this year or beginning of next year, we will not be able to truly put this pandemic behind us. Meanwhile, we've also seen a re-escalation of geopolitical tensions between the US and China. Here, Trump faces a balancing act, talking tough on China to resuscitate his chances in the November elections, but not tough enough to undermine the stock market. So these are the sort of factors that we're looking at. One of the main concerns we've faced from clients outside of obviously COVID-19 related concerns is the elevated level of valuations. Now, valuations can be looked at in different ways. So on this chart, we have on the left-hand side more traditional ways of looking at valuations. So whether you're looking at price to earnings ratio and price to book ratio. And clearly on these metrics, equities are expensive. However, the third bar shows that equities actually are relatively cheap when you look at G3 government bonds. So overall, our net assessment is that we continue to expect global equities to perform well in the coming 6 to 12 months and outperform government bonds and cash. Meanwhile, we believe that excess capacity, for example, very high unemployment rates around the world, generated by the short and sharp recession, will take years to fall to pre-crisis levels. This will keep central banks very focused on keeping interest rates low to support the economy rather than worrying about controlling inflation. This is likely to force income-hungry investors to take on additional risk to achieve their income targets. Therefore, we expect multi-asset income strategies, which invest in high dividend yielding equities, bonds, and other high-yielding assets, perform well over the coming 6 to 12 months as people continue to allocate to these asset classes. This clearly has big implications for our view on bonds. But before we get into that, it can be interesting to look at what we call an outside view, which is basically a quantitative approach to see what has happened historically. So what this table shows is historical returns of different bond asset classes when developed market high yield spreads or risk premium are around current levels, which we consider to be cheap relative to history. As the table illustrates, historical returns from today's valuation ranges have been very strong. We ran a similar analysis actually when we looked at spreads for EM US dollar government bonds. And here the returns were actually even higher than shown in this table. Of course, we have to acknowledge that the current absolute level of bond yields are lower than they were in the past, which suggests that returns may be lower going forward than this simple analysis would suggest. But our net assessment is that credit, which is corporate bonds and EM US dollar government bonds, will continue to do well. So our investment process starts with the outside view, and then we look at the inside view, which is a more qualitative view of the current environment. And here we can see that credit is likely to can outperform equities in the early stages of the recovery after a recession. And the main reason for this is that the companies tend to refocus their attention on repairing balance sheets in the early stages of a recovery, which is good for bondholders, rather than paying out dividends or conducting share buybacks, which obviously would be much more favourable to shareholders. So our view is that at this stage of the environment, credit is likely to outperform equities. Credit is, of course, a large asset class, so it's worth stepping down to our preferences within this. We specifically like three areas in credit: developed market, high yield bonds, EM US dollar government bonds, and Asia US dollar bonds. And this slide is one way of viewing the risk-reward trade-off that these bonds offer relative to the broader bond universe. It simply shows us that the trade-off between yield and the level of volatility for each bond asset class. On these two measures alone, up and left are clearly the preferred direction, either i.e. higher yield and lower volatility. And you can see that our three preferred areas in credit all score well on this up and left ranking, i.e. they offer higher yields per unit of volatility compared to local currency bonds or investment grade bonds. For Asia US dollar bonds, while the yield is actually still quite low, it ranks higher than other major bond asset classes when you consider the yield on offer per unit of volatility, i.e. it's a very low volatility asset class. Moving on to developed market high yield bonds, these score well in terms of yield, albeit at a much higher level of volatility and risk of drawdown than Asia US dollar bonds. However, what we believe makes DM high yield bonds attractive is the scope for price gains in addition to the high yield on offer. The third and final area we like within bonds is EM US dollar government bonds. The valuation argument is very similar to that of high yield bonds. Credit spreads have fallen from the crisis peaks but still leave room for further price gains if the recovery continues. The key risk to credit is rising defaults, either at the country or the company level. We expect continued stress to develop in the coming months, and obviously how the pandemic pans out from here will be important, as will how policy evolves. However, historically, we have seen defaults peak well after the credit asset classes have bottomed, and believe that is what we're seeing today. Moving on to equities, global equities have moved swiftly back into bull market territory, with global equities up 40% from the March low. Optimism that the policy response will ensure a short, sharp recession has driven expectations that global earnings will recover swiftly into 2021. The current consensus is for 19% decline in corporate earnings this year, but then a sharp recovery thereafter. Investors are concerned over expensive valuations in global equity markets, which are trading on a 2020 PE of 21 times. While these concerns are understandable, we note that high valuations reflect the collapse in 2020 earnings expectations. Based on a recovery in 2021 earnings, market valuations are much more reasonable at 17 times. And as I mentioned earlier, relative to government bonds, equities actually still look relatively cheap. US, Asia ex-Japan and Euro area are all ranked as preferred, with little to distinguish their relative performance outlook, in our opinion. Earnings forecasts and lead indicators for growth are recovering sharply in all three regions. US equities are undoubtedly expensive. Nevertheless, we believe that the profile of the earnings recovery and the skew towards the fast-growing technology sector justifies the premium investors pay to gain exposure to the market. As mentioned earlier, alternative valuation metrics are much more supportive in the US's case as well. Asia ex-Japan is also preferred, and within the region, China is our most preferred market. Drivers of our optimism include the technology sector, which is the largest sector in Asia ex-Japan, and using a broad classification of technology, also the primary driver of the MSCI China Index. China, Asia ex-Japan performance is driven in part by global technology trends, including the Philadelphia Semiconductor Index. The region is riding on the wave of global appetite for technology companies, which are also being empowered by the concentration of consumer spending in this sector, often at the expense of old world economies such as high street retail. An additional driver of optimism towards China is the ongoing development of the Connect program between Hong Kong and China. Investors are familiar with the Stock Connect, Bond Connect and FX Connect, and these have now been joined by Wealth Connect this year. This is an exciting new development and will connect 11 cities in the Greater Bay Area to transact in wealth management products. Specifically, mainland Chinese investors can purchase wealth management products available for sale in Hong Kong and vice versa. The size of the market in these cities is around 70 million people, with a GDP that's close to the size of Canada. Finally, within equities, we view euro area equities as attractive from earnings growth, policy stimulus, and low bond yield perspectives. As with elsewhere, we expect investors to look through the 2020 corporate earnings weakness towards the recovery in 2021. Monetary and fiscal policy measures should underpin the recovery for euro area equities. In particular, we are interested in the concept of a euro area recovery fund, which could reduce perceived political risks and lead to a positive re-rating of euro area equities. The euro area's dividend yield remains attractive relative to low bond yields, despite dividends already having been reduced by over 20% in the face of reducing earnings. And we have become more constructive on the region's important banking sector. Finally, we want to talk about the dollar and gold. So we have a bearish view on the dollar over a 6 to 12 month basis. Most of the long-term drivers for the dollar are bearish. Interest rate differentials turned against the dollar about a year ago, and we were talking about it when I was last in Korea, and these continue to do so. Long-term US dollar valuations are also elevated. What we believe is important from a catalyst point of view in the second half is the dramatic influx of global liquidity following significant Fed actions. So we believe the dollar is likely to fall against most G10 currencies, particularly the euro, Australian dollar, and the pound sterling. A weaker dollar, along with low real yields, should also be supportive of gold. We forecast a move to 1850 to 1900 as we go into the next 6 to 12 months. And a test of the 2011 high of 1920 cannot be ruled out. With that, I'd like to thank you again for taking the time to listen to me today. As I said, I really look forward to coming back to Korea and meeting you all in person. And with that, I'd like to say thank you very much